Welcome to the Mental Health Market Update, where we talk about what's happening in the mental health industry. Here's your host, Stephen Hayes.
Welcome back to the Stigma podcast. I'm your host, Stephen Hayes, and today we're doing a special mental health market update as we have some big news today, August 5th, in the world of disruptive healthcare companies, which is where we as a behavioral health-focused investor are focused. Teladoc is acquiring Livongo for a valuation of approximately $18.5 billion. So I'm going to do a little bit of analysis on the deal and then talk about what I think it means to entrepreneurs in the digital health space. I've been publishing thoughts on Livongo and Teladoc quite a bit lately, and recently I told you on a podcast that if I was Teladoc, I'd be out using my most valuable currency, my stock, to make acquisitions. Since that podcast on June 26th, Teladoc has acquired two companies. One was In Touch, and then today they announced they will be acquiring Livongo. The $18.5 billion price tag on Livongo is based on the closing stock price of both companies as of August 4th and implies a premium of about 10% for Livongo shareholders as of August 4th. The valuation multiple here is absolutely astronomical. This valuation represents about a 55x multiple on Livongo's 2020 consensus revenue and about a 37x multiple on their 2021 consensus revenue. Once the merger is completed, Teladoc's existing shareholders will own about 58% of the business, and Livongo's existing shareholders will own about 42% of the combined company. And I mentioned that, and I'll come back to that in a few minutes, and it's important when we start talking about contribution margins in the pro forma business. When it comes to the form of consideration, Livongo's shareholders are going to receive 0.592 shares of Teladoc for every share of Livongo. Plus, they're going to receive just over $11 of cash per share of Livongo that they own. The combined company will have an expected fiscal year 2020 pro forma revenue of about $1.3 billion, which as a combined entity would put them up about 85% year over year in terms of growth. Combined company will also have a pro forma EBITDA of around $120 million, representing an EBITDA margin of around 9%. According to the combined management call this morning, the combined company will drive revenue synergies of about $100 million by the end of the second year following close, reaching $500 million on a run rate basis by 2025, along with cost synergies of $60 million by the end of the second year following close, which is anticipated to take place in Q4 of this year, 2020. After the combination is complete, the pro forma company will do business as Teladoc Health, that'll be the name, and it'll be headquartered in New York. I listened to the combined management call this morning, and I was struck by a comment that Teladoc CEO Jason Gorvic said. He talked about how this merger was inevitable, as the two companies were on a collision course that was accelerated by market dynamics around COVID-19. I don't disagree. I know Livongo was hungry for a telehealth acquisition based on what some insiders told me recently, and I know Teladoc has been looking to make acquisitions and has done so in the digital space. So this all makes sense from that perspective. One thing that did stand out to me is the pro forma ownership compared to the contribution margin around revenue. When we analyze M&A deals, often we look at a contribution analysis, and in this situation, it's interesting. The combined company will have pro forma revenue for 2020 of about $1.3 billion, of which Livongo contributes 26% of that, but they end up owning 42% of the pro forma company, and they get a cash payout in this transaction as well. I found that quite interesting. I know Livongo traded down today, but honestly, that's a function of Teladoc stock getting slammed today because they're now linked by an exchange ratio. Livongo got a great deal here, in my opinion. Let's talk a little bit about the market reaction. So upon seeing this announcement, I immediately honestly had a negative reaction to it. And then I looked at the market reaction and realized I wasn't the only one. It really has to do with how these companies are growing top line, but not really improving margins much, if any, and their valuations are not even rooted in reality. As of market close on August 4th, Teladoc was trading at $249 per share, which reflects a revenue multiple of 19.4x consensus 2020 revenue. At the end of the trading day today, August 5th, and after the announcement this morning, Teladoc's stock price dropped all the way to $202, reflecting a single-day drop of 19%. Just for some context, this is the same stock price they were trading at back when we did our deep dive podcast on June 26th, which was before they announced the In Touch acquisition. Now they've announced another acquisition, continued COVID-driven top-line outperformance, and continued stagnant EBITDA growth. Now they're acquiring another high-growth, low-margin business, and people really shouldn't be surprised at the market reaction. The stock price has traded back to where it was before any of these deals were announced. Over the course of the last year, Teladoc's next 12-month revenue multiple has gone from 6.8x to 17x today. That's over the last 12 months. While on a 2020 basis, they're trading at 19x revenue. During that same time period, Livongo saw their next 12-month revenue multiple go from 16.4x all the way down to 4.6x in March of this year, and now it trades at 33.5 times its next 12 months revenue. Can anyone actually argue that the business has improved so much that they deserve a re-rating of their revenue or multiple expansion from 4.6 to 33.5x their forward revenue? This is a single-digit EBITDA margin business whose strategy was going to be to buy a telehealth provider and continued toward this pro forma business model on its own that's been replicated by this deal, but then they bailed on that and sold because, well, why wouldn't you at this valuation? Good job, Livongo, on selling high. I mean, good on you guys, for real. The equity analyst over at JP Morgan made a comment in their research report today that said they don't expect competing offers on this deal because of the valuation, which I think is a polite way of saying what I just said. So what? You may be asking, as entrepreneurs in the digital health space, what does this mean to me? And look, I made some bold statements here, and I could very well be wrong about some of my opinions. The evidence has shown me that in my life, I'm wrong more than I'm right. So I wouldn't be surprised about that. So take the opinions with a grain of salt if you want. But if you're building in the digital health tech space right now, you definitely need to take note of a few things. One, obviously the valuation multiples. If I'm a founder in the space, I'm leveraging the heck out of these new public market comps to drive my fundraising valuation higher and to drive the expectations of what my future value could be higher in the eyes of my investors. Number two, and more interesting to me really, is the business model these guys are cobbling together at Teladoc with a focus on chronic disease management using measurement-based care and technology. Acquisitions are going to pick up in the space as more providers, payers, and others realize they need to piece together a platform that provides more than just brick and mortar or general care. They are going to need to treat chronic conditions with measurement-based care and do so with the payer's total patient cost in mind. I think this combination of telehealth provider with a focus on chronic comorbidities while leveraging technology to do so via testing, measurement, and monitoring and data analysis is the way of the future. Is this the right combination? I mean, these two specific companies, and are these valuations too high? And can this management team deliver? I mean, I can't answer those questions, but I can tell you that Teladoc is smart to increase their exposure to and their focus on treating chronic conditions, and doing so with the ability to track outcomes digitally and gather data on those outcomes, which is one thing that Livongo is very good at, among many other things, of course. Just to dig in there a little bit, the market for chronic conditions in the United States is absolutely massive, and it's growing. Roughly 147 million Americans, or just under half the population, are living with a chronic condition, with greater than 40% of the population having two or more chronic conditions. Because these patients are more expensive to treat, roughly 90% of healthcare dollars are spent on these conditions. Teladoc has been talking about investing in a chronic care platform for quite some time. They expressed interest in others in the past and made a strategic investment in Vita Health by investing in their Series C back in June of 2019. Vita Health provides virtual care for both physical and behavioral health patients who suffer from chronic diseases. Why does this matter so much for behavioral health entrepreneurs? Pay attention to the business model. I've said this before. These companies are moving toward a business model that I described a few minutes ago that you need to take note of as a founder. Chronic comorbidities are exacerbated by mental health differences, addiction, mental illness, depression, and so on. A lot of the businesses we are funding in the mental health space that succeed will help reduce the total cost of care for patients with comorbid chronic diseases who also suffer from a mental health difference or substance use disorder. The justification for acquiring Livongo will be a very similar justification used for the slew of coming acquisitions in the behavioral healthcare market. Treating specific conditions using measurement-based care, doing it well, and then offering that person or that patient a continuum of care is a model that seems to work and that Teladoc is willing to pay a significant premium for it. I suspect others will pay a premium for it too, which is why we are investing heavily in the future acquisition targets around behavioral health that will help other acquirers get to this model too. So that's it for today's brief event-driven mental health market update. We do have a bit of news to announce here at the Stigma podcast today. Our venture fund, What If Ventures, launched a new investing vehicle this week. We've been operating as a syndicate with 6 investments and have deployed about $3.2 million into the mental health startup space since January of this year. We were recently accepted into the early access program at AngelList for their new rolling fund product and launched our rolling fund this week. It's a new kind of venture investing vehicle that is basically a subscription-based venture capital fund structure that allows investors the ability to make smaller, more flexible commitments than they would in a normal venture fund where they have to make a 10-year commitment. You can check us out via the link in the show notes or on our website. But enough about that. To our listeners, thank you so much for being here. And please, if you like this content, hook us up with a subscribe or a like or a review on your podcast platform of choice and share us with a friend. To the founders out there, don't forget to join the Mental Health Startup Slack community, which you can find a link to in the show notes. And most importantly, we want to hear from you. Please do comment on social media. Let us know what you liked, what you want to hear more of. You can reach out to us on Twitter at StigmaCast. You can find us on Instagram at Stigma Podcast. You can email us at info@stigmapodcast.com. Thank you again for being here. That's it. Until next time, stay safe, be well, and thank you for your support.